The echoes of the 2008 financial crisis are resounding through the current banking landscape, as a new wave of banking concerns emerges. Let's delve into the striking similarities between the current banking crisis and the one experienced during the Great Financial Crisis of 2008. Furthermore, we explore the reasons why it is prudent to prepare for potentially worse times ahead. The root causes: inadequate risk hedging. Both crises can be traced back to a fundamental failure on the part of banks to adequately hedge the risks associated with loans and mortgages. In 2008, banks were lured into providing loans to borrowers without a proper assessment of their repayment capabilities. Similarly, the current crisis is characterized by banks' poor management of interest rate risk, particularly investing in long-term treasuries without anticipating the impact of rising interest rates. These reckless lending and investment practices have led to vulnerabilities in the financial system, jeopardizing the stability of banks and triggering a chain reaction of events. Interconnectedness and systemic risks. The interconnectivity of banks played a pivotal role in the severity of the 2008 crisis. Complex financial instruments and the packaging of faulty loans as safe investments spread the contagion throughout the global financial system. While the current crisis does not exhibit the same degree of interconnectivity, it is important to recognize the potential for systemic risks. The failure of banks such as First Republic and Credit Suisse underscores the contagious nature of banking crises, as confidence erodes and contagion spreads beyond regional boundaries. The concentration of unrealized losses on banks' balance sheets, coupled with the sizable holdings of fixed-income securities by the Federal Reserve, poses significant risks to the overall stability of the financial system. Regulatory oversight and lessons unlearned. In both crises, regulatory oversights and a failure to enforce stringent risk management practices have played a significant role. The lack of action by financial regulators leading up to the crises is a cause for concern. Financial institutions were allowed to operate with insufficient safeguards, which ultimately contributed to the catastrophic events. Despite post-2008 reforms aimed at enhancing oversight and regulation, the current crisis suggests that some lessons have not been fully learned. The repetition of similar risks, such as inadequate risk hedging and excessive reliance on short-term deposits, indicates a failure to address core issues. This regulatory complacency raises doubts about the resilience of the banking system in the face of future challenges. Implications for investors and stakeholders. The fallout from the 2008 crisis resulted in significant losses for investors and stakeholders, and the current crisis poses similar risks. Bondholders, stockholders, and preferred shareholders have already experienced substantial losses as banks falter. The decline in equity capital cushions, combined with the potential panic among depositors, could lead to a sharp drop in bank stock prices and exacerbate the crisis further. The acquisition of failing banks by larger institutions, while aimed at instilling confidence, may have long-term implications and unintended consequences, as evidenced by past examples. Preparing for uncertain times ahead. Given the striking similarities between the current banking crisis and the 2008 financial meltdown, it is essential to prepare for potentially worse times ahead. The vulnerabilities exposed by the current crisis underscore the need for robust risk management practices, enhanced regulatory oversight, and proactive measures by financial institutions. Investors should exercise caution and consider diversifying their portfolios to include distressed debt and inflation-protecting investments. Furthermore, proactive steps must be taken to address systemic risks, improve transparency, and bolster the resilience of the banking system to prevent future crises. As we examine the parallels between the current banking crisis and the 2008 financial meltdown, it is important to understand the implications for the average person and how they can navigate the uncertain times ahead. History has shown that financial crises have far-reaching consequences that extend beyond the banking sector, affecting individuals and households. It is crucial for people to be proactive and take steps to protect themselves in the face of potential economic hardships. First and foremost, individuals should prioritize their financial well-being by maintaining a robust emergency fund. Having a cushion of savings can help weather unexpected challenges, such as job loss or reduced income. Additionally, it is prudent to diversify investments and carefully evaluate the risk associated with different financial instruments. Seeking professional advice can provide valuable guidance in navigating the complex financial landscape. Furthermore, staying informed and educated about the state of the economy and financial markets is crucial. By understanding the warning signs and recognizing potential risks, individuals can make informed decisions and adjust their financial strategies accordingly. Keeping a close eye on personal debt levels and ensuring responsible borrowing practices are also essential during economic uncertainty. Lastly, fostering a mindset of resilience and adaptability is vital. Tough times require individuals to be flexible and resourceful in finding alternative sources of income or exploring new career opportunities. Developing new skills, enhancing job marketability, and pursuing additional education or training can help mitigate the impact of economic downturns. While the current banking crisis may evoke concerns reminiscent of the 2008 financial meltdown, individuals can take proactive measures to protect their financial well-being. The average person can navigate tough times with greater resilience and maintain a stronger financial foundation by focusing on financial preparedness, diversification, education, and adaptability. Thanks for watching this long. If you enjoyed the video, please smash the like button on your way out.